Hi everyone, this is Alok Patnia and welcome for another masterclass. And today's masterclass is very important. We will be decoding some of the interesting parameters which a SaaS company or a SaaS business need to track month on month basis. Some of the interesting dashboards and interesting parameters which every SaaS business need to uh, prepare and need to measure on a monthly and weekly basis. So let me first introduce ourselves. This is Alok Patni. I'm the managing partner and founder at Tax Mantra Global. I've got 23 plus years of experience in global finance and taxation and cross-border structuring. Uh, I head Tax Mantra Global, which is a cross-border tax and legal firm. We are based out of 5 countries: uh, the US, UK, Singapore, UAE, and India. And as an organization, we have helped close to 750 businesses in the last 15 years, wherein we have helped them to scale globally, help them in their compliances, help them in their fundraise compliances, RBI compliances, CFO advisory services, CFO compliance service, and due diligence. We have also worked with a lot of VC firms, PE funds, and help them in their for their portfolio companies when they invest into their portfolio companies. And we have been awarded by the Times Group, and I have also been awarded, and I've been featured on the Leaders of Tomorrow program. With me today, I have got Sada, who is a tax partner and partner in our CFO and advisory practice. He's based out of Bangalore, and he has got 20 plus years of experience in global finance, and he has been a leader, a finance leader in Dell, Vodafone, Bhumi, and Bank Bazaar. So he has also led a couple of companies in their CFO readiness experience, and ultimately in their CFO journey. So he has worked with domestic plus family offices and VC firms. So today, this masterclass will be very interesting, as I was talking about. And so let me first give you a background in terms of what we will be covering. So there are, as I said, that a SaaS business needs to cover and measure some of the interesting key parameters, which is monthly recurring revenue, or the CAC, which is basically the cost of acquisition of a customer, the churn, which is logo versus revenue, the NRR, which is net revenue retention, DAU, MAU, and WOW. So I think with this, I will hand over to Sada, who will go more deep into this, and I will pitch in whenever there is a need. Let's make this webinar very interesting and engaging. Over to you, Sada.
Thanks, Alok. Hi, team. So here, we are going to go deeper into each of those parameters. First, let's talk about MRR. So
Let's
this
first
is the
go. Let's first go to those 5 parameters once, Sada.
yeah, sure.
Let's first discuss these parameters for a couple of minutes.
Mhm. I think so monthly recurring revenue is uh, basically what is your revenue that you are getting month on month. It's pretty simple. We are anyway going to cover all those things much more in detail.
Mm,
Um, and the second metric we are talking about CAC payback period, where how long it takes to recover your cost of acquisition of your customer. Right, there
right,
are different calculation methods are there, and the different metrics and market benchmarks are available, which we can look at it.
right,
And the next parameter is churn, where you got to track your customer number of customers who are churning, and the customer how much of revenue that they are taking away from you, right? So churn is a very good, very critical parameter to check in SaaS business, because whatever the amount of or the number of customers that you acquire, they have to be retained, a substantial part of that. If we are not retaining, then we are working on a leaky bucket. right?
Right.
And then coming to NRR, net revenue retention, it's again kind of talks back to the churn, uh, where how your existing customer base should be able to grow. Yes, on one side you are able to bring in more customers, but your current customer set also you should be able to dive deeper and make it more like you should be able to farm from the current set of customers. So how much are you able to farm, and your current customer set, how are they growing? NRR talks about that. And then the last parameter we are talking about, the users, daily users, weekly users, monthly users. Yeah, on one side we are talking about revenue, profitability, and cost, but we should also focus on the number of customers, because that's the fundamental base on which all of your cost revenue mechanisms are built. uh, so if you
You're
have any
right.
comment, you can
No, no, let's move
follow.
ahead. So, no, no, I think these five parameters are very critical for a SaaS business. So let's now
Yeah.
explain one by one so that it is for our users who would understand, for our audience, what is these parameters and why these parameters are so important. Yeah.
Yeah, so here, so let's start with a metric that everything else hangs on, and it's the monthly recurring revenue. In
Right.
a SaaS business, if you don't know your MRR precisely, you're basically flying blindfolded. MRR is simply the total value of all active subscriptions in a given month, normalized to a monthly number. So if someone pays you annually, you don't call that full amount as this month revenue. You divide it by 12, and only that counts as monthly portion. So that's how the formula works. There are a couple of mistakes, big mistakes that show up again and again. The first thing is that founders mix one-time revenue into MRR, like your on-time revenues like implementation fee, consulting fee, custom projects, all these things, by mistake gets into your MRR revenue. And when you are using your MIS report, it's fine, but when it's coming from top of your mind, you might misunderstand that. So it makes the graph looks attractive when you call out all those numbers, include all those numbers into the MRR, but it's not the right number. So the moment investor due diligence starts, this gets shown up as an erroneous item, and your MRR that you thought it is the right MRR, can come down drastically. That kind of doesn't give a right look with the investors. The second thing is that uh, they only look at total MRR and ignore what's driving it. The healthy SaaS doesn't grow because you add new customers. It grows because existing customers are also expand, and we need to go deeper into that. Like more seats, higher plans, add-ons, all those things we need to bring it in. So you should always look at MRR as a waterfall, starting with starting MRR plus new MRR plus expansion minus contraction minus churn. So that's how the MRR as a formula it works. So if you're
Got it.
not seeing that breakdown every month, you don't truly know what's happening under the hood, right? So as a thumb rule, early stage SaaS should target roughly about 8 to 12% MRR growth per month. As you scale, you can expect about 3 to 5 months per month is a strong parameter. But the quality of the growth matters more than the headline number. Growth powered by the discounts, or burning a lot of money, that's not a sustainable growth, but it has to be through a sustainable means. So the goal is simple: one clean, reconciled MRR number every month. Tying back to the books and the billing system is always trusted source, and you can confidently go and talk to the investor that this is my MRR and this is growing at this phase, year on year, month on month. This is the number it's growing. So that kind of a very basic parameter for any investor uh, to look and judge the business.
Right, right, right. Completely agree with you on this.
All right. So let's move on to the next one, which is NRR. So in NRR, if you see, it's a net recurring revenue. Sorry, net revenue retention is one of the most important number in SaaS business because it tells you whether your existing customer base is compounding or quietly shrinking, like what I explained earlier. The question NRR is very simple. If we stop selling to the new customers today, what would happen to our revenue over the next year from the customers we already have? Is it going to grow up or is going to be shrinking? So it is supposed to be a compounding engine. We need to expand, we need to form, we need to go deeper into the current segment of accounts. That shows the health of the revenue. I think, Alok, you keep talking about the revenue health, right? So this
Yes.
is one of the main parameters to evaluate the health of the revenue.
Right. So I think the quality of revenue is so important in businesses, and more so in a SaaS business, because when I said quality of revenue, that basically net revenue retention also plays a big role in determining what is the quality of the revenue, in the sense that are we able to retain customers? Are we able to increase the LTV of the customer? Are we able to get more business from that current customer? Are we able to retain for a longer period of time with the right satisfaction, right? Uh, so I think for that, and to measure that, I think net revenue retention is a very, very key parameter for any business. And if for SaaS business, it is much more, because at the end of the day, the main science of a SaaS business is a subscription business, right? So if and that subscription need to increase month on month, and the value should increase month on month, and the quality of the custom feedback should also increase. Yeah.
True, true. So when your NRR is high and consistent, your new sales stops being the only growth engine, but your installed base itself becomes the growth engine, and that's where the SaaS becomes truly powerful, and your businesses will be more, compounding, and the profitability kind of keeps multiplying,
Right.
right? So going into the next one, which is CAC payback period. So CAC payback period answers a brutally practical question. That is, if you spend money to win a customer today, how much months it takes to get that back money, to get the money back in profit terms, not in terms of revenue. Many times this gets miscalculated, compared against revenue, but that's not right. It's the gross profit that we need to compute, which gives you the right parameter about the business performance, and that's the generally accepted market understanding. So to compute it, you first work out your monthly gross profit per customer, that is average revenue per account multiplied by the gross margin rate. And if let's say if your customer pays 10,000 a month and your gross margin is 80%, then you earn 8,000 as a gross profit per month from that customer. If you fully loaded CAC to acquire that customer is 80,000, your payback is 10 months. After 10 months, it's effectively goes into your, it's your profit, so that customer starts giving you more than what you pay to acquire that customer. So where people go wrong is by actually doing it against the revenue. That's the main area where things go wrong. Whenever people talk about CAC payback period, somebody will talk about revenue, and that comes out look like a crazy number. And then people start wondering what the hell is that number all about, right? But
Right.
it's always that we should compare it, tag it against against the profit, not against the revenue.
Very, very, very important point on this. And we have in our experience, we have seen when we do due diligence that many of the MIS reports talk about the revenue, but that's
Yeah.
not the current metrics, because at the end of the day, what is the profit you are able to generate from that client or from that customer? And you give the right example. So I think that is very, very important for SaaS businesses. And
Yeah,
this is one of the important parameters which VC firms also look at, and more so at a Series A, Series B level, because by that time they have enough data point to analyze and see that what kind of CAC you have and what is the CAC payback period you have. Because then you can really analyze whether this business can really scale at a profitable and sustainable basis.
true. That's true. And the faster we, the quicker the CAC that we recover, the better it is for the investors and the business. So in today's environment, right, a sub 12 months payback is really attractive. So 12 to 18 months can work, if your retention is excellent and if you're strong balance sheet, and you can go beyond that. You're relying heavily on external capital to fund growth, which is fine as long as there's a healthy funding and the pipeline is there.
Right.
Okay, so let's jump on to the next one, which is churn. Churn, like I said, is a critical parameters to look at it. Otherwise, if we don't monitor the churn, either in logos or in revenue, mainly the revenue churn, it'll be like a bucket that you're filling, but the bucket is a leaky bucket. The more you pour, it keeps leaking, but you'll end up spending more money on acquiring the customers, but you're not making money anywhere, right? So that's essentially is about the churn. But there are few calculation metrics which are there, which we can talk about it now. So you can so you lose 10 tiny customers paying 1,000 each. Uh, it's not a good parameter. It's not a good thing to lose a customer, but in terms of revenue, you're not losing much. But let's say if you're losing a customer who's paying $1 million, in terms of revenue, you're losing much, but not in terms of the customer numbers. So both you need to evaluate and understand, where what is going wrong. Um, so that you are able to control. So if let's say there are 100 customers who are giving 1,000 rupees or leaving, there must be some parameter, there must be some kind of an driver that's kind of is playing, because of which they're churning out. And tomorrow it can be 1,000 rupee customers, and currently the 1,000 rupee customer can be tomorrow maybe customers who potentially can pay $1 million. So we need to address that issue as well, though the revenue is low, and we need to take care of the high paying customer as well, while reviewing the churn, either at logo side or at the revenue side. The next one is daily average users and monthly average users, and weekly average users. So this one is basically it's a there is no the market benchmark that is available, and it depends on your industry that in which you are operating, the geography that in which you're operating. It's completely based on that. uh, you need to definitely measure the average users, though there are a lot of users that must be registered in your platform, but measuring their activeness in the platform is definitely required, and constantly measuring them helps you keep the customers active and go deeper, and uh, go basically it'll help you go deeper into the customer base that you already have,
Right.
right? Right. And on to so these are the top five parameters that we covered. So now we are coming to the next six parameters. Though we said, we are going to cover only top five, but it comes with few other parameters that are
This is the
really critical.
bonus. This is the bonus which you are giving. The bonus next six parameters, and in fact, these parameters are also very important.
Yeah. Yeah. So let's start with sales pipeline velocity. Most founders talk about pipeline like, we have 20 crores of deals in the funnel. That sounds nice, but it doesn't tell you when that will hit your bank. So pipeline velocity is basically how much revenue moves through the funnel per month, given number of qualified leads, your win rate, average deal size, and the average time a deal takes to close. Right. So that's about sales pipeline velocity. It helps you to understand the health or the rate at which it can feed into your business operations. Right. Second thing is about ARPU or ARPAs, like ARPU, average revenue per user, or average revenue per account. So this is a very simple math. The total MRR divided by total users or total accounts. So in B2B, we usually look at average revenue per account. In B2B, it is ARPU, which is average revenue per user. What does it mean? Because it tells you how well you are monetizing your customer base. Is your typical account paying you 3,000 a month or 30,000 a month? Over a time, a healthy SaaS usually sees ARPU going up in the ideal segment, because you're either moving up market, adding more seats, or selling more value. So there is no universal ARPU or ARPA. It completely depends on the product and the segment that at which we are addressing. But once we know the product and the market segment that you are operating in, we will definitely be able to get what is the current market ARPU or ARPA that's there, which we can benchmark. So the third one is basically booking, billing, and revenue. It's not a parameter as such, but it's the term that many of us, many SaaS founders and people in SaaS use it. Just to clarify, we thought we'll put it here. The bookings are basically the total contract value that you have signed. It can be 3-year contract, it can be 5-year contract, whatever it is, right? In case of what is billing is what you're actually invoicing in the period. So you may be billing once in a year, um, for a contract that is 3-year or 5-year contracts. But whatever we are billing is it can be quarterly or it can be yearly. Whatever we invoice to them is called billing revenue. But what really goes into the P&L is the revenue piece, which is if let's say you bill it in advance for 1 year, it gets recognized every month. So every month, whatever you're booking in your books is called the revenue. But so this is how the term generally works. Like for example, if I say it's a 12 lakh per year, it's a let's talk about a 36 lakh booking revenue. The first year you will bill for 12 lakhs, and you will book 1 lakh as a revenue. So that's 12 lakh divided by 12 is 1 lakh. 1 lakh is the revenue. So what we are talking about as revenue is 1 lakh, billing is 12 lakh, and booking is 36 lakh. Right? So we should not misplace the numbers, and that doesn't give a right picture. And the next one is the universal rule of 40. Any SaaS business, anybody in the SaaS kind of looks at this metric, especially the current age investors look at it. What it means is that your revenue growth percentage plus profit margin percentage should be 40 or above. That means you're well and good. So that means either your revenue is growing or your profit is growing at a very well recognized rate. Your revenue can be zero, your profit can be high, and your profit can be zero and your revenue can be high. End of the day, it's a different dynamics playing out, growing revenue or growing profit. But end of the day, the business is growing well, balanced. Sometimes it's balanced more on revenue, sometimes it's balanced more on margin, but we are going well. That's the 40 principle. The 40 percentage is a principle that's applied when you're well above 40, you're considered a good SaaS business, healthy SaaS business. Right.
Got
The
it.
next one is about LTV to CAC. So that's LTV is basically uh, how much gross profit do we make over the life of the typical customer, and how is that compared to the CAC? So we incur an amount to get a customer, that's CAC, and what is the benefit, lifelong benefit that we get from the customer, right? So we compare this. There are some market metrics are there that we can compare and understand which is good, which is not good, which is really great. All that analysis we can do, but this is basically it about LTV to CAC ratio, right? The last one is burn rate and cash runway, which is very standard metrics. As any business owner or a founder or a CFO, we will definitely need to ensure that we're looking at the burn rate and also have a visibility to what is our runway, and accordingly either we kind of have the funding pipeline, and or we have a mechanism to control our costs so that we are able to extend our runway, which will help us turn the business in a profitable way over a period of time,
Right,
right?
right, Sada. I think these are very, very important metrics which you have just suggested, and these metrics are so important to measure for SaaS business on a month-to-month basis. In fact, I would suggest that some of these metrics should be measured on a week-to-week basis, even though the concept of MRR really works well. And I was just reading one of the reports by Stanford University on the unicorn pattern. So there is a report which suggested that more than 80% of businesses who raise pre-series A round or a seed round, they are not able to raise the next round. That means that only 20% of people who have raised pre-series A or seed round goes and raise further rounds. And also, out of these people who try to raise further round, 60% of these people are not able to clear their due diligence because a their governance or their metrics or their MIS reports or their accounting grouping is not correct. B their metrics is also not correct. So I think we as a firm, we always try to help businesses, and that's the reason we thought that we will get into this very important webinar where we will talk about these important metrics which every SaaS business should have in their MIS on a weekly or a periodically basis, and they should start measuring this. Now, if we can move ahead, and this is very important for you to know in terms of as a firm what we do. So we provide comprehensive CFO advisory compliance services, be it basic plan wherein we include basic compliances, which is bookkeeping and payroll and other compliances. We also provide a CFO advisory, which is more of a functional ongoing role. Or we also provide CFO advisory fractional, which is basically time based or project based, right? But what I would suggest is that whatever you do and whatever you try to achieve in terms of whether you want to do it in house or you want to take our help, this is something which you really need to do. So that you can go to the next slide, and we there are couple of very interesting examples. For example, we have helped Swiggy to travel the journey from zero to the IPO stage, and what kind of MIS reports and dashboards which we created for them in the initial years, which helped them to continue to raise millions and millions of dollars and continue to raise so many rounds, continue to clear due diligence, continue to create that confidence and the trust in the minds of the investor, is something which will be very important. And we have also helped many startups to get acquired. If you go to the next case study, Sada, we have helped one of the startup called Poshwine, which had Singapore and India operations, get acquired by Razorpay at a 5x revenue multiple. And I think there we have actually implemented a dashboard, which was global dashboard, which actually gave a bird's eye view reporting to the founder and business owners in terms of what's happening to their compliances and different metrics from a cross country basis. So as I said, and we thought that this webinar will be interesting for you in terms of understanding what all insights you need to work on. Uh, we can go to the next slide. And so I think we have already spoken about why Tax Mantra Global. And we have a legacy of 40 plus years, as I was talking about. And we have 150 plus global experts in different jurisdictions. And we offer cross-border business structuring and global setup. We offer CFOs advisory. We also offer cross-border structuring setup and ESOP implementation, contract management implementation, all those services. So I think if you want to book a one-to-one consultation with us, we can provide you a complimentary consultation wherein for a 30-minute, wherein our subject matter expert or practice expert can come and talk to you and understand your current situation in terms of either A, in terms of where your compliances are those compliances on track and in control and compliant? B, what kind of metrics you are tracking from a month to month basis, and how can we help you to create better tracking metrics and dashboards we can help you to implement, which will give you a bird eye view in terms of what's happening in your organization. So I think if you are interested, and we are also running a lot of offers for the new year, so you may utilize some of our offers for the new year which is coming. So I think do contact our team. Our contact details is there on the last slide, and our team will also put the contact details on YouTube when this video will go live on YouTube. So thanks for joining in today. This is what we wanted to provide today in this masterclass. And Sada, any last thought from you?
No, I mean, so these are really critical parameters, and with my experience that I've worked with many SaaS companies in the past, I can definitely be able to help them with more setting up more comprehensive systems and process in place so that they're able to be investor ready all the time.
Got it. Got it. Got it. So thanks for joining in today, everyone, and thanks Sada for doing this very interesting, insightful masterclass for all of us. And we will come back soon with more insightful masterclass for the benefit of the ecosystem and founders and investors at large. Thanks again.
Thank you.